Megaworld. Next slide, please. So firstly, Megaworld is one of the Philippines' largest real estate companies, a local powerhouse with 853 buildings, 35 townships, and 7,000 plus hectares of land and over 300 billion pesos in assets. We're also an internationally awarded real estate developer. Furthermore, they also lead in 3 rapidly growing segments above average. In fact, the industry average being 6.2%. Hotel income, real estate sales, and rental significantly above average. Next slide, please. So, especially given its strong leadership, mainly Dr. Andrew Tan, the chairman and founder of MEG, as well as Lourdes Gutierrez Alfonso, with over 30 plus years experience in real estate. They're also backed by one of the Philippines' largest conglomerate, the Alliance Group, a company with a strong network spanning multiple industries from alcohol, real estate construction, restaurant, of course, Megaworld, tourism, further giving it access to synergies and capital spanning its $1 billion portfolio.
Now, Megaworld exhibits solid growth, driven primarily by 3 main economic trends in the real estate industry. The first is the right economic fundamentals, which is seen through the growing population and rising incomes in the nation, resulting in a larger consumer base. Second is strong market conditions, which is observed by A, lowering interest rates, which result in greater market liquidity. B, a growing real estate sector outside of Manila. In fact, many cities outside of Metro Manila, like Angeles, Bacolod, and Cebu, are growing at a larger and faster rate than cities within Manila. And C is the growth of the BPO IT industry, which increases office demand, rentals, and property value. The third is robust government support, which can be observed with the strong real estate investment through tax incentives, housing loan programs, and REIT frameworks driving infrastructure growth. Next slide, please. However, it does face strong competition due to the presence of 2 key players, namely Ayala Land and SM Prime. Now, Megaworld is the 3rd largest real estate company in a highly competitive real estate industry in the Philippines. However, the 2 aforementioned companies are really the only competition that Megaworld has to worry about, given the industry that they operate in, with many barriers preventing smaller players from catching up, which include high capital investment, because the real estate industry is a very expensive industry to operate in. B, strong government regulation, because it is very difficult to get real estate developments down if you don't have a good relationship with the government. And C, market barriers, because barriers such as economies of scale and brand loyalty disproportionately favor bigger and more established brands.
Given the steep competition and the economic landscape, MEG still stands out amongst its peers, and the market being poised in a position to outperform the industry. And we present to you today the 4 key value propositions. First being townships in prime locations with rapid growth. This is strategic for MEG as they're choosing areas outside Metro Manila since it is oversaturated, and in these places they're going to construct new central business districts, making world-class residentials, hotels, lifestyle malls, and the such. Second is, MEG is the largest office landlord in the Philippines, with 1.5 million square meters of office space, and even being the largest, they're still doubling down on a 30 billion peso additional investments. This comes as BPO IT industry is having a faster growth rate than the real estate sector. This also comes at a time with new international entrants to the country such as X, formerly Twitter, and JP Morgan Chase even expanding to more offices. Third is the end-to-end ownership or vertically integrated business. Megaworld is able to have oversight over its quality control and cost efficiency. The fourth is diverse portfolio where Megaworld is able to absorb any risk and even maximize their market capitalization. Next slide. And this results into a industry-leading profitability. As you can see here, MEG has a higher profitability than the industry. Next slide. And with that, they're able to have a healthy balance sheet with lower debt to equity, higher liquidity, the industry again. And as for that, we have higher returns and even higher dividends.
So nextly, to assess how this affects the company valuation, we use not one, not two, but three valuation methods. The first one is the intrinsic valuation, where we get the discounted cash flow to equity of MEG in 10 years and the terminal value across three different scenarios: the base case, the bull case, and the bear case. Secondly, we have the comparative valuation. For comparative valuation, we compare the valuation multiples of MEG across 12 different companies with a very similar business model. And we got the valuation range from the low and the high percentile. Nextly, we have the precedent transaction valuation, wherein we get the historical valuation of MEG in 5 years along with 12 competitors, the same 12 companies here. And for more information about this, we are more than happy to let you know about this, on how we computed these valuation methods in the Q&A. Nextly, while all these three valuation methods showed the key message, showed the same key message. MEG is massively undervalued by 38 to 65%. That's a big discount with a big margin of safety. Even if, let's say, our calculation or assumptions are a bit wrong, or maybe they are very wrong, MEG is still undervalued by a massive margin. And here, our target price is around 3 pesos. That's 20% with a 20% margin of safety. Next please. So, our sensitivity analysis shows that even with a low growth rate and price to earnings, MEG is still undervalued. Even at a 1/3 growth rate, at 2.67%, at a higher discount rate, MEG is still undervalued massively. And with PE ratio, even if the price increased by 50% suddenly, the PE ratio is still undervalued. And so, we have an amazing company at a very affordable price.
Now, while other risks in the real estate industry exist, Megaworld's differentiation strategically positions it to resist the market. Megaworld faces three main key risks. However, these risks are already being mitigated through the company's current strategies. The first risk is the oversupply and price depreciation of residential real estate in Metro Manila, which is being mitigated by MEG's strong investment in many townships outside of Metro Manila, which diversifies the risk away. The second is the POGO exit, lowering down office occupancy rates, driving down prices. However, it must be noted that MEG serves large stable corporations like Wells Fargo, JP Morgan, Microsoft, and others, not illegal players, so their rent rates don't really go down as a result of the POGO exit. The third is the negative public image for residential real estate due to supposed issues of lackluster quality and overpricing. However, MEG is taking steps to address this by positioning itself as a premier choice for the upper middle class by developing new upscale residencies with enhanced amenities in prime business districts like Makati, Araneta, and others.
Alright, so to conclude, given all the previous points, our recommendation is a strong buy due to two reasons: right drivers of growth and state of being undervalued by the market. However, investors must be wary of some key risks that are already being addressed. So thank you everyone for listening to our pitch. We'd be happy to discuss every single one of our valuations that we computed from scratch in the appendices. Thank you.